This week was another down week in the stock market, with the S&P 500 falling 2.51% for the week and closing at 3340.97. Thank you for watching this video. My name is Rodney Constable. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the president and founder of Simple Market Signals at simplemarketsignals.com. Today we will be doing technical analysis on the S&P 500 for the week ending 9/11 of 2020, and for this analysis we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. The first chart that we're going to look at here is a 5-year weekly candlestick chart of the S&P 500. The green line is the 10-week moving average, which of course is equivalent to the 50-day on the daily charts. And the blue line is the 40-week moving average, which of course is equivalent to the 200-day moving average. What we can see here is we've been down in the S&P 500 now for 2 straight weeks, and we stopped right above this 10-week moving average. So, you know, the markets oftentimes do pull back to that 10-week moving average and then continue to go higher. So that is one possibility here. However, we are still well extended above the longer-term moving average, and what we know is that over time, the market will continue to pull back to its long-term moving average, or of course, go below it. So the gap here still makes us vulnerable to further downside. Additionally, we're in what is traditionally the worst month of the year, September. We're in the worst seasonal period for the year, August, September, and October. We're only 2 months out from what is going to be a very contentious presidential election. There's still a lot of uncertainties out here, guys. You know, coronavirus still spreading. We don't know what earnings are going to be like on the S&P 500, and so there's still a lot of uncertainty here. So the good news is, in the short term here, we continue to close above the 50-day or the 10-week, and I'll show you a daily chart here in just a second. But we continue to close above the 10-week moving average, so that is good news. However, further downside is definitely possible over the next 2 to 6 weeks. The next chart that we're going to look at is an 18-month daily candlestick chart of the S&P 500. So each candlestick represents 1 day of trading. And in this chart, we can see the horizontal blue lines. Those are the support and resistance levels. We'll talk about that. The orange line is the 200-day moving average. So we know that the 40-week, right, setting right here at the 3100 level, is the same basically as the 200-day moving average. So we'll touch on that here on the daily chart in just a second. I want to start on this trend line, though. This trend line was drawn underneath the trend, the uptrend that we had intact that started at the end of June and went until last Friday. We broke beneath this candle right here. We broke beneath this uptrend line last Friday, and you can see this week's trading came right down to this first blue line, which is 3330, which we'll come back to here in just a second. So one of the things we'll want to keep our eye on over the next couple of weeks is if the market tries to rally, what happens when we get up to this trend line? Can we get back above and get on trend, or will we hit our head, so to speak, on this trend line and then once again roll over? If we put in a short-term bottom here, and that's a possibility, and I'll show you that here on this chart and then in the next one. It's possible that today, Friday the 11th, we put in a short-term bottom, and I'll show you what I'm looking at there. But if that's the case and we start to rally back up over the next couple of weeks, then one possibility is that we get stuck underneath this trend line, get rejected, and roll back over. The other possibility is that this market just continues to motor on higher and we jump back above this trend line and get on trend and continue to make all-time highs in the S&P 500 going into the end of the year. So either one of those at this point is possible. In the short term, however, you know, it's really hard to tell, guys, but let's move on here. So this first blue line is 3330. Now, what's important about this, and I'll show you a shorter term chart here in a second, is we came right down to this 3330 level and traded right at that level for a good portion of this week. You can see that the 3330 level provided some support at the beginning of August, and then going back to the beginning of the year, you can see that in January of 2020, The 3330 level acted as overhead resistance for a few days and then also acted as an area of support, minor support, for a few days during February before, of course, we broke down and had the correction. So as long as we stay above 3330, and again, we closed at 3340.97 to end the week, but as long as we stay above 3330, then the worst is behind us, right? But if we break down below 3330, which would also mean we would break beneath this 10-week moving average, right? So if we break beneath that 10-week moving average, the 50-day moving average, and that 3330 level, then we will fall probably down to at least the 3200 level. You can see that 3200 acted as an area of support for a good portion of the month of July. A little bit of trading around this area in June, and a little bit of trading back at the end of December right around this area. So there is some support, not a ton, but some support at 3200. The greater area of support beneath where we are currently trading is down at 3,000. And you can see that the 3,000 area for most of the month of June and at the tail end of May, we kind of kept bouncing off of that area. We had some trading right around in there in February and the beginning of March. And you can see back in October of 19, trading right around that area here, September, and back into July. So the 3,000 area on the S&P 500 is the major area of support beneath where we are currently trading. If we fall beneath 3330 over the next week or two, then 3200, and then even 3100, because oftentimes, the markets will pull back to their 200-day moving average. Oftentimes they'll go slightly beneath that, and if that is the case, then again, the 3,000 level would be that downside target at this point. So the good news is we stopped at the 50-day moving average this week, but don't get overly confident here, guys, because there's still a lot of risk in these markets, and these markets are still very elevated above their long-term moving average. So further downside is definitely a possibility, especially during this time of the year. The next chart that we're going to look at is a 4-day, 5-minute candlestick chart of the S&P 500. So that's just this week's trading. Of course, Monday, the 7th, the market was closed for Labor Day. So what we're looking at here is Tuesday, Wednesday, Thursday, and Friday of this week. And the blue line is set at 3330. So what we can see here is on Tuesday, the 8th, we bounced right off of this 3330 level. Several times, right? Closed just above it on Tuesday, but you can see how that held up intraday on Tuesday. Of course, we traded well above it on the 9th and then pulled right back down to this level intraday on Thursday the 10th and bounced off of it. Today, on Friday the 11th, we traded for a little while this afternoon below this 3330 level, but we were able to claw our way back above that and again closed at 3340.97. So you can see here that we've continued to bounce this week off of that 3330 level, but we haven't closed beneath it. So that's what's so critical here. And you can see, guys, this is algorithms, right? Over 70% of all trading in the markets now are done via algorithms. So that's why it's so important to, as I say, put the market under the microscope and look at these short-term, these intraday charts, the 1, the 2, the 5, and the 10-minute charts to see what's going on in the markets in the middle of the day, okay? But what's important here is where we closed. So the good news is, even though we traded for a little while this afternoon beneath this 3330 level, the good news is that that level held and we closed above that. The fact that we closed above 3330, very, very important. And the fact that we kind of tested this area and it held up could be, and this is what I was talking about on the previous chart where I said, we might have put in a short-term bottom today. This may have been the test. So the good news is in the short term, we passed this test, right? We passed the 3330 test in the fact that we went beneath it, but we were able to get back above it and close above 3330. So over the next couple of weeks, as long as we can continue to close above 3330, we're probably going to be okay. However, if we start to see daily closes beneath the 3330 level, that means the market is continuing to weaken, and that's where we might see 3200. And if that doesn't hold, then again, we could go all the way down to at least the 200-day moving average, which we know right now to be setting right around the 3100 level. And if that doesn't hold, then again, 3000 would be the downside target, and there's quite a bit of support at 3,000. And also, guys, for those of you that have been with me for a while, you know that I talk about this, but these round numbers like 3,000, they are oftentimes psychological, and this has been true for over a century, right? Traders from over a century ago used to write about this, but these round numbers like 3,000 oftentimes provide major areas of support and resistance. So that's just another reason why this 3,000 level is so important. Hopefully we won't see that anytime soon, but we don't know. And there's still a lot of volatility in this market, a lot of risk in this market, and the market, even though it's pulled back over the last couple of weeks, is still very, very extended over its long-term moving average. The next chart that we're going to look at is for the triple Qs. The triple Q, of course, is the ETF that tracks the Nasdaq 100. And on the Nasdaq 100, we were down 4.63% for the week, and we closed just beneath the 10-week moving average. So we're just a hair below it, so it's not that big of a deal. But guys, we're still trading over 17% above the long-term moving average, even after we pulled back for the last couple of weeks. And we're down about 10% from the all-time highs on the Nasdaq 100. And then when you look at the fundamentals of the stocks inside of the Nasdaq 100, some of these things are trading at still really, really high multiples, whether you're looking at price to sales or price to earnings. Even though we've fallen about 10% over the last 2 weeks on the triple Qs, I would still be careful here because there is the potential for another 10, 15, even 20% downside over the next 2 to 6 weeks or so. Caution is still advised here. Before we go any further, let me ask you a question. Do you have a stock market risk management system? Something that helps you understand the various risk levels in the stock market on an ongoing basis? Do you know when it's safest to be in equities? Do you know when it's most dangerous to be in equities? Do you know the direction of the short-term trend on an ongoing basis? Do you know the direction of the overall trend in the stock market? My system is called Simple Market Signals. Simple Market Signals is market-based. There's no opinions, forecasts, or guesswork in Simple Market Signals. It took me over 20 years to develop Simple Market Signals. I developed Simple Market Signals by reverse engineering the stock market, and I studied the stock market over numerous time frames, including in numerous bull and bear markets. And what I found is that certain conditions exist during these various market phases. And then based on that information, I created simple, easy to understand signals around these different phases of the market. And the thing is that most people don't know about or have access to the data necessary to do the research that I had to do to put together this model. Now let's take a look at the signals. The red signal has the highest equity risk associated with it, and the worst sell-offs, including bear markets, will happen when the signal is red. When the signal is yellow, this means that equity risk is moderate, and sideways to slightly up or down price action is very common during a yellow signal environment. The green signal is the best signal. It has the lowest equity risk associated with it, and most all upward progress in the stock market will be made in a green signal environment. Said another way, it is very hard to make money in equities unless the signal is green. Okay, a quick refresher on the Simple Market Signals weekly signals and how they can help you. The signals are green, yellow, and red. The green signal is the best risk-reward ratio for equity investors, and what you're going to find is that the stock market makes most of its upward progress when the signal is green, okay? The worst risk-reward ratio signal for equity investors is when the signal is red, and what you're going to find is that bear markets and the worst downturns in the stock market happen when the signal is red, like during the 07 through 09 bear market, as we see here. So again, the best risk-reward ratio signal for equity investors is when the signal is green, and the worst risk-reward signal for equity investors is when the signal is red. Now let's take a look at the first 3 months of 2020 so you can see how simple market signals could have helped you in the most recent downturn. We know that we came into the year with a strong stock market, so we had a green signal for the majority of January, but on January 27th, the signal went yellow for a couple of weeks. We went back to green in the first part of February, and then we know that we hit the all-time high on February 19th at 3386.15. That is the closing high so far on the S&P 500. And then we had this intraday reversal on Thursday, which I talked about in my Simple Market Signals newsletter, which of course is how I disseminate these signals. And then we closed lower on Friday again. And so what we can see here is, and I warned my newsletter subscribers on Saturday, the 22nd of February, that I felt like the market was starting to roll over and that that things were changing. And so I gave people a heads up right here over the weekend. And I told them that if the market continued to sell off, that we would probably see at least a yellow signal, if not worse, the following week. And that's exactly what happened. On the 24th, the Simple Market Signals risk signal went yellow. Now, one of the other things that I want to point out here is, in addition to the risk signal, I also have several trend direction indicators in this Simple Market Signals model. Now, the longer term one is called the general trend indicator, and the general trend indicator went negative on the 25th. So on the 24th, the signal went yellow. The general trend indicator went negative on the 25th, and then 2 days later, the signal went red. The risk signal went red. So think about this. All in 1 week, just a few days apart, we had a yellow signal, we had the general trend indicator went negative, and then we had the risk signal went red on the 27th. That was Thursday, all right? And by the way, this general trend indicator is a positive negative signal, okay? And it operates totally independently of the risk signals. It's just trend. So the general trend indicator gives you still another way to monitor and control risk in your portfolio. And guys, that general trend indicator had been positive since October, all right? So that thing had been positive for, 5-6 months and then went negative. So right there, just those two signals alone told us that something was changing in the stock market. And then by the 27th, the signal had went red, and we can see here that the market fell from there. As part of the Simple Market Signals model, there are three powerful indicators. There's the Simple Market Signals proprietary risk level signal. There's the short-term trend indicator, which helps clarify short-term moves in the overall U.S. stock market. And a normal signal length for the short-term trend indicator is anywhere from 1 or 2 days to 7+ weeks. Then there's the general trend indicator, which is designed to stay positive during the bulk of most uptrends and negative during the bulk of most downtrends. And a normal signal length for the general trend indicator is anywhere from 2 weeks to 5+ months. We disseminate the information through the Simple Market Signals weekly newsletter. In the weekly newsletter, you will receive the proprietary risk level signal on the overall U.S. stock market. You will also receive the proprietary risk level signal on all 11 major sectors of the S&P 500. You will also receive the short-term trend indicator signal. You will also receive the general trend indicator signal. You will also receive market and sector performance information over multiple time frames. You will receive a recap of what happened in the stock market for the past week. You'll also receive technical analysis information, fundamental analysis information, and yield curve information. There is a ton of information every week in the Simple Market Signals newsletter. And a subscription to Simple Market Signals is just $19.95 per month. That's less than 67 cents per day. It's billed monthly on your credit card. There are no contracts. You can cancel anytime, and your first 2 weeks are free. And guys, I want to set realistic expectations here, okay? The newsletter isn't fancy. It's effective. It's plain text, no color, no fluff. And please note that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to subscribe to Simple Market Signals. And again, that is just due to international compliance regulations. Now let's recap what you will get with your Simple Market Signals subscription. You will get the weekly emailed newsletter with all of the contents we just talked about. You will also receive special midweek updates when warranted. So if there's a major signal or direction change in the middle of the week, we're not going to wait until the weekend to get you that information. We're going to get that information to you as soon as possible via a special midweek update email. The best fit for a Simple Market Signals subscriber is an investor or trader with at least a 6 to 8 week plus time frame that they're focusing on. If you're a day trader or a really short-term trader, Simple Market Signals may help you a little bit, but the reality is Simple Market Signals is designed for those investors and traders with at least a 6 to 8 week plus time frame that they're focusing on. And if you would like even more information about how you can benefit from Simple Market Signals, I have the following videos that will be linked in the description box below this video. And to subscribe to Simple Market Signals, you just need to go to the website that you see on the screen here. That's https://simplemarketsignals.com. It'll take you about 4 minutes to subscribe. It's that easy. Once you reach the website, the first thing you will need to do is accept the cookies. Please notice that due to international compliance regulations, you must be at least 18 years old and a citizen of the United States of America who is currently living in the U.S. in order to use this website or our services. And that is just due to international compliance regulations. All right, so to get started, all you have to do is click this green button, and that will take you to the product page. And this explains, of course, what you get with your subscription. And then just make sure that that says 1, because if there's more than 1 in there, if you have a 2 or a 3, you'll get multiple subscriptions to the service and you only need 1. Click the Sign Up Now button, and that will take you to the checkout page. Once you're on the checkout page, fill in the necessary information, anything that is required, including the email address. Keep in mind that this is an email newsletter, so we will have to have your best email address on file, and make sure this box is checked because that's how your email address gets into the system. So if that is unchecked, your email won't get transferred into the Simple Market Signals system and you won't get your newsletters. So please make sure that box is checked. And then, of course, just double check, make sure that your monthly total is going to be $19.95 a month. Remember that your first 2 weeks are free, so your first renewal date will be 2 weeks after your subscription date. Fill in your credit card information. You will need to accept the privacy policy and check that box that says you've read and agreed to the terms and conditions. Click the Sign Up Now button, and it's that easy, guys. It's probably going to take you maybe 4 or 5 minutes total to fill in everything and subscribe to Simple Market Signals. Now, when you subscribe, okay, understand that everything is tied to your email on file. All right. So once you subscribe, you go out to the website, simplemarketsignals.com, and it'll take you maybe 5 minutes to subscribe. It's pretty easy. And you just follow the prompts, and then your email on file is then going to drive everything going forward. This is an emailed newsletter subscription. That's how we disseminate the information. And you should get an immediate emailed confirmation of your subscription. You will also receive an automatic welcome letter that is automatically generated once you subscribe. So if you don't get that welcome letter beyond your confirmation, okay, of the subscription, if you don't get that welcome letter, if you don't see it in your in-basket, then go check your spam, your junk, or your promotion folders, especially in Gmail. Having a lot of people that are having the newsletters and everything coming from Simple Market Signals going into the promotion folder. So please make sure that you check your spam, your junk, and your promotion folders. And also understand that the newsletters go out on the weekend. All right. So the goal is to get it out Saturdays by 2 p.m. But it could be any time over the weekend, depending on how long it's taken me to do the research necessary for that week's newsletter. But I try to get it out by 2 p.m. Eastern Standard Time every Saturday if I can. Again, earlier if I can make that happen. And then the next edition right? Once you subscribe, understand that the next edition, right? So if you just subscribe on a Monday, Tuesday, Wednesday, whatever, the next regular edition is going to be set out on Saturday. All right. And then once you subscribe, we will send you as soon as we can the latest edition, but we have to send that out manually. So just be patient with us. But again, within a day or two of your subscription, if you don't get this latest edition, then go back and check your spam, junk, and promotion folders because it's probably hidden in there. All right. So you should get the automatic welcome letter and then the latest edition within the next day or two of your subscription. And then again, the standard newsletter goes out every weekend, but we try to make it no later than 2 p.m. Eastern Standard Time on any Saturday.